how to speak to different individuals in your business acquisition journey or your business acquisition endeavor. Because I can talk about the core interactions you're going to have, and what you say to a banker is going to be very different than what you say to an investor. What you say to an advisor that you may be wanting to bring onto your team for equity, that's going to be different than what you say to a broker. So let's talk about it. We'll go in the order that I generally recommend you follow when you're going out to buy your first business in the game of acquisition entrepreneurship, right? Probably you're going to start after you choose an industry or you decide what type of a business you're looking to buy. Usually the first step then is building a deal team. I've talked about this a lot on my social media platforms, and you can watch more videos about this, but I generally recommend an accountant, a lawyer, and an industry expert. The accountant should have auditing or general P&L understanding, right? They should be really able to analyze financials. Your attorney needs to be an M&A attorney, a business acquisition attorney. We don't need a litigator. We don't need the lawyer that sued O.J. Simpson for murder. Okay, that's not what we're looking for. We're looking for a M&A attorney, a mergers and acquisitions attorney. And then we're looking for an advisor that has a lot of industry experience in the industry that you're going to be making acquisitions in. So when I got into the plumbing business, I brought on somebody with 35 years of plumbing experience, right? So that's the deal team. That's really what I recommend. And you can bring these people on without paying them cash. I recommend in many cases giving them equity, a couple of points, a couple of percentage points in the businesses you're going to buy. I'll talk more, again, other videos, I talk more about that. But let's think for a moment about what an advisor wants if you're going to give them equity. If that's the carrot, if that's the incentive that you're offering, what do you think they want? What are they interested in? What matters to them? These are important questions to ask yourself if you're going to be a persuasive communicator. If you're going to successfully persuade these highly qualified and highly competent individuals to join your team, then you're going to want to think wisely about what you emphasize to them. Well, let's ask this. Are they putting money into the deal? Usually no. That's not at least what I teach. So most likely no, they're not putting money into the deal. What are they putting into the deal? Time, right? Effectively, you're saying, I'll give you equity in my deal in exchange for some of your time and your expertise. So in that regard, they don't have money to lose, but they do have time to lose, right? And you're not paying them in cash the way I talk about it. You're giving them equity. So in that regard, what do they really want more than anything? They want you to be super successful, and they want the equity that they're being given by joining you in the very early stages to become fantastically valuable, right? So then what's the thing we probably want to emphasize to an advisor more than anything? Of course, be honest and sincere, but what's the most persuasive thing we could say to that advisor? Let's talk about how we're going to build the biggest, baddest, best business this side of the Mississippi. Let's talk about building a $1 billion enterprise, or at least a $100 million enterprise. We are going to take over this industry and dominate and build a massive enterprise over the coming 5 to 10 years. That's persuasive. Why? Because you're giving them equity. In the way that equity turns into a meaningful, tangible value to this advisor is by you being super successful in your endeavors. So when it comes to speaking to an advisor, the very most persuasive thing you can say, in my opinion, other than them being bought in on you, and we'll talk about more about how to pitch some of this, but other than you selling yourself, it's you selling the fact that you have a great plan, a great opportunity, you're the kind of individual who can get the job done, and all it really requires is the right team to get there, and then the execution. And by you all coming together, we can be successful. I know I can do it, but I know I can't do it alone. And that's why I'm reaching out to you, Mr. Lawyer, or you, Mr. Accountant, so that we together can build a massive, successful company. And I want to give you some equity so that you can be incentivized to help us grow this thing into the massive company that I know we can build and create by making acquisitions in the ABC industry. So that's really how we want to talk to an advisor. Now let's talk about a banker. A banker is very different. A banker is providing you debt, right? Those of you who understand finance a little bit understand that debt has no upside. It's just the principal plus the interest. You're going to repay the money that you've been given plus interest. And that's the deal. That's it. Whether you have a massive amount of success for your company or not, doesn't really matter to the banker. As long as you don't default on the loan, the banker's good. So do you think when you're talking to a banker, you want to talk as much about upside? Probably not. The banker doesn't want to hear about your billion-dollar endeavors. To be honest, that usually scares a banker. What a banker wants to understand much more so is that you have the risk management skills to make sure that you're going to always make every single payment in full and on time. That's what a banker wants. They want downside protection. They want to make sure they don't have to explain to the president of the bank or their boss why they gave you some loan that you were unable to pay. So the language you're going to use for an advisor is completely different than the language you're going to use to a banker. Your endeavors are the same. Your intentions are the same. But the parts of your business plan, let's just say, that you're emphasizing are quite different when you're speaking to the advisor than they are when you're speaking to the banker. It's kind of like if you go out, let's say you're a young guy, you're a 23-year-old guy. You just graduated college. How you talk to your buddies on a Friday night at the bar, is that going to be a little different than how you speak to your mother-in-law or your girlfriend's mom at Sunday morning for brunch? Probably so, right? The things you say to your buddies at 11 o'clock or midnight, at the middle of the night in a bar, probably a little different than what you're going to say to your mother-in-law at 10 in the morning. It's still you. Who you are hasn't fundamentally changed, but there's different sides of yourself. And how you present yourself to your mother-in-law, a little different than how you present yourself to your buddies at 11 o'clock at night in a bar. Okay, so this is really what we're talking about here, is understanding what your audience needs to hear for them to be comfortable enough to proceed in the deal-making endeavors with you. It's not lying. You're not full of shit. You're sincere, you're straightforward, you have big ambitions, but you also understand that you need to make sure you don't default on your debt to be able to achieve those ambitions. So you emphasize your prudence and your risk management skills to the banker, whereas you emphasize the upside and the opportunity to the advisor who's getting the equity. Speaking of equity, let's talk a little bit about investors. What do investors want? In my opinion, they want the best of both. They want the upside of a Silicon Valley startup, but without all the downside risk. And this is usually how I sell Main Street acquisition investment opportunities. The upside of Silicon Valley without all the downside. Here, you're actually going to make sure we don't lose your money. But you still have massive upside by investing in this business acquisition at this early stage, right? If you're raising your equity for your first couple of deals. So you can provide them a real amount of upside if you have this big opportunity that you're trying to achieve by buying businesses and building a portfolio in a given industry. But because it's a Main Street investment, the odds of the business going kaput, especially if you pick the right industry, are quite low. You pick an industry or a business that's Amazon-proof, that's AI-proof, that's going to do great no matter whether there's a Democrat or a Republican in office. You pick a business in a great market, a growing market, and it's pretty hard for you as somebody who's raising equity from investors to lose that investor's capital. As long as you manage your debt right, which is why it's important that you do stay prudent when you're growing through acquisition. But what we say to an investor is different than what we say to a banker, is different than what we say to an advisor if we're trying to bring that advisor on in exchange for equity.